Hello everyone, welcome back. In this video, we will be discussing on the first two steps of the month-end checklist. It is a continuation from our earlier video on month-end closing of books of accounts. If you haven't watched that yet, please check the link in the description and view it first. It will help you to follow today's concepts smoothly. So first, why should we even record all the transactions? Why does it matter? Now, when any transactions are missed, the entire financial picture becomes distorted. Accurate books leads to accurate decision. It prevents omission and duplication. They build trust with the management, auditors, clients, and users of the financial statements. Most importantly, they help you maintain strong internal controls, thereby being a very important skill for every accountant. So, let's understand how to make your accounting system complete and error free. So, the first step is always to ensure that all the transactions are recorded. Any work that we do, we should have focus, discipline, and we have to plan the work before doing it. Similarly, in accounting as well, to ensure that all the transactions are recorded correctly, there should be a plan or a task. Basically, what has to be done on a daily basis, on a weekly basis, and on a monthly basis. So, few transactions that could be done on a daily basis is to ensure that all the cash receipts, cash payments, bank transactions, sales invoices, purchase invoices, petty cash, all of these are recorded. Weekly tasks include reviewing the pending vendor bills, customer invoices, the statement of accounts from the suppliers and the customers from the bank, and to ensure that they are matching with our books. Monthly tasks is to ensure that all the accruals, prepayments, depreciations, provisions are all recorded. So the checklist is your first line of defense against any missing entries. Once you have followed and done the tasks as per the checklist, then you can appreciate yourself for your discipline, thereby ensuring that none of the transactions are missed. The next step is to ensure that the statement of account, as mentioned earlier, which has to be done at least on a weekly basis, like the bank, supplier, customers, all of it tally with your books. This is confirmed by doing a reconciliation of the statements with the ledger. Reconciliation is your safety net. They reveal if anything is missed. If a transaction is not entered, then reconciliation will expose it. So the requirement to do the reconciliation is very simple. It is just the statement and your ledger. So, what is bank reconciliation? Bank reconciliation plays a major role in your books of accounts. It is to compare that your cash book and the bank statement tallies. So, what is the purpose of doing a bank reconciliation? It is to identify if there are any differences between the bank statement and your cash book, reconcile the balances so that you ensure accuracy, detect any errors, and correct them. It prevents fraud and strengthens the internal control. And as mentioned earlier, the documents that you would need is just the bank statement on the date of reconciliation and the bank ledger from the books as on the date of reconciliation. What all can be the reasons that there are differences in the bank statement and the ledger? So, three main reasons can be identified. The first is the timing differences, second one is the omission, and the third one is the errors. So, what do you mean by each of it? Let's see in detail. Timing differences means that consider a check is issued by the company, but the supplier has not yet presented it to their bank account. In such cases, in the books of my company, I would have already passed the entry in my cash book, but in the bank statement, it wouldn't have cleared. So these differences is because of the time of presenting the check by the supplier in the bank. There can be other way around as well. That is, when I have submitted a check or I have deposited a check in the bank and it is not yet cleared by the bank. The reasons can be ABC. But in my books, I have recorded the transactions, I have debited it. But in the bank account, the amount is not credited. So these are the reasons for timing differences. The second reason could be omission. What is omission? Omission is something which is missed to be recorded. For example, if there was any bank charges deducted by the bank that I haven't noted or recorded in my books, or if I have received some interest in the bank account which is not recorded in my books. All these are omissions. The third one is error. Error can be of two types. One is the error from the bank side, which is very rare, but yes, it can also happen. The second one is errors from the business side. Business side, in the sense, maybe like you have entered the amount wrongly, you have recorded the transaction, so there is no omission, but then there is an error in it. It need not be fraud, but a mistake, a clerical mistake as well. So, all these differences can be corrected during bank reconciliation. So, what are the formats of preparing bank reconciliation statements? Basically, there are two formats to prepare the bank reconciliation statement. The first format is to start with the bank balance as per the bank statement and arrive at the bank balance as per the ledger. The second format is to start with the bank balance as per the ledger or the books and arrive at the bank balance as per the statement. Let's see both the type of preparation. So first type is to start with the bank balance as per the bank statement. So here what happens is whatever is the bank statement bank balance as on the date of reconciliation, you consider that, and to that you add few items and you subtract few items so that you arrive at the adjusted cash book balance. So what are the items that we will add? It could be, like for example, deposits in transit, meaning to say the checks which is deposited but not yet cleared in the bank, because this would already be recorded in the cash book but not yet in the bank statement, so that have to be added. Or it could be payments like bank charges or errors which is decreasing the bank balance and it is not recorded in the cash book, like those which are omitted in the cash book. So these transactions have to be added in the reconciliation statement to the bank balance as per the bank statement. So now what has to be subtracted? The one that I will subtract would be the outstanding checks which I have issued to the supplier, but he has not presented in the bank or it is not yet cleared from the bank. Also, if there has been any receipts which is posted in the bank statement but not recorded in the cash book, those have also to be subtracted. So doing these two, I would arrive at the adjusted cash book balance. The next format is to start with the bank balance as per the ledger or the books and then to arrive at the bank balance as per the statement. So in the same way, we would be adding few items, subtracting few items and then arriving at the balance as per the bank statement. So what are the items that I would add here? So basically, whatever I subtracted in my earlier format, I would add them here, like outstanding checks which are issued but not yet presented, which I have already recorded in my ledger, I would be adding it. And if there are any receipts in the bank statement which I have not recorded, I would be adding that as well, as my cash balance has to increase. What I would subtract are those checks which are deposited but not yet cleared, and if there has been any payments or reductions in my bank statement which I have omitted in my cash book. So doing this, I would arrive at the balance as per the bank statement. So these are the first two steps of the monthly closing of books of accounts. Once again, to revise, it is to ensure that all the transactions are recorded. And the second one is to do the bank reconciliation and to ensure that they are tallying with the books of accounts. In the upcoming videos, we would be looking at further steps of the monthly closing of books. Stay tuned. Please do like, share, and subscribe to our video to keep yourself updated. Thank you.